Oh, hello, everybody. My name is Frank Thole. I'm Managing Director of WEPEX, a boutique management consultancy focused on the financial markets. We are trusted advisor for banks, exchanges, asset managers, and similar financial institutions. I have here an interesting round of experts around me. And we are going to discuss about native digital assets and traditional finance. So our understanding of digital asset is which going beyond electronic securities according to the Electronic Securities Act in Germany, beyond MiCA, also other digital assets, and we would like to compare this with traditional finance instruments, bond, shares, funds, CTFs, money market FX, and so on. So we start then that everybody would introduce himself in this round and a brief statement how your work connects with this convergence of digital assets and traditional finance.
Okay, so let me start. So my name is Stephan Mögelin. Hello, everyone on this session. So I'm working in BaFin for over 16 years, so most of them in the supervision of financial market infrastructures, and over the last 6 to 7 years, looking into the potential implications resulting from the application of DLT in financial market, and therefore I'm already on the intersection of financial markets as traditional and new technologies being applied. Thank you.
Thank you. Oya.
Hello, my name is Oya. I'm sales director for EMEA for Ondo Finance. I've been in crypto for about 4 years. Before that, I spent 15 years in traditional banking. And Ondo Finance designs assets, platforms, and infrastructure to help bring traditional financial markets on chain. We started with tokenizing treasuries, so bringing US treasuries on chain, and now we're moving on to publicly listed equities and ETFs, among other things.
Amy.
Hi, I'm Amy Oldenburg from Morgan Stanley. I actually run our global emerging market investing business, so I sit on the buy side of our organization. I'm also heavily involved in our digital asset initiatives there. I used to trade emerging market FX a very long time ago, probably close to 20 years ago. So very similar to what the digital asset space is like today. And we've been working on trying to implement and understand where the different pieces of digital assets fit into the different divisions of our business.
And last but not least, Ben.
Hey, yeah, I'm Ben Duve. I work for GK8 by Galaxy. I'm the global head of partnerships. What we do is we provide the safest and most trustworthy in software and technological infrastructure for any institutional clients who can self-custody. And maybe for the convergence, in my prior roles last year, I was at the central bank writing for the Digital Capital Market Union. Before I was at BNY looking at tokenization from a global custodian's perspective. And before that, I was at Commerzbank, headed custody and digital assets already 5 years ago. So quite early on, and going from a very traditional environment now into a more or very digital one, very crypto, close to crypto, and Galaxy Digital is a very close to crypto firm. I think I might be a little bit of convergence.
Thank you. For context, let us define native digital assets. Oya, perhaps you can start, and the others can then pitch in. What are native digital assets for you?
I think for the context of this discussion, I would confine our definition to blockchain. So I would say any asset that is minted or exchanged on the blockchain that has some value.
Yeah, I think it's important for the native digital to keep in mind there are two versions of that. That's where you take a digital, something truly digital, and tokenize it. So there's no real world, however you want to call it, offline connectivity to the token, right? That's then the real ultimate goal, but most assets are not, right? And then you have what I always call securitization, and some people like to call tokenization, where you take an asset, you structure it, you actually end up in the very traditional format, and then you create a digital representation of it and move it around. So both can be seen as somehow native digital, right? But one really is a tokenized securitization process, and the other one, there's no offline, off-chain asset existing anymore. I think the latter is what really the whole thing is about right now. And the first one is the future, right? Because the latter is where all the costs, all the inefficiencies, all the infrastructure challenges lie, while the first one, everything is truly native digital, at least for a government bond, a security, and all of those, it actually works, right? A building, it's very difficult because it actually exists.
Stephan, what is your view from the financial authority?
So yeah, interesting to hear. So I would say that digital assets indeed is a very broad term, and it is often used, and there might be, from a regulatory perspective, a need for distinction, because we heard here actually traditional instruments like financial instruments, like Ben said, all these things around bond and shares, which might be tokenized or not. And here I would argue that native financial instruments are directly issued by using a blockchain or DLT system. But on the other side, we also have crypto assets, which by nature are native to the blockchain protocol. And from a regulatory perspective, it's really distinguish or a need for distinction between these different types of financial instruments and crypto asset, because when it comes to providing these services, so at least for financial institutions and crypto asset service providers, it is really of importance which framework should be applied. So that is what I would like to highlight here and to keep in mind when talking digital assets.
Amy, from your perspective, what role do the crypto native players play versus traditional financial institutions?
Oh boy, that's a loaded question. You know, I think the one thing that they can do is sometimes explore and play is not the right word. Just they can test things that we cannot test because they don't always have the same requirements that we have. So I think we actually watch the crypto space very closely. One of the things that I was very interested in last week, I was at the Digital Asset Summit in New York, and one of the big themes that I kept hearing is a lot of the folks that were in the traditional finance space waiting for regulation to change. And, you know, it's changing now, at least in the US and more broadly. And a lot of the talent that's been in the traditional finance space is just pushing further into DeFi now and really going into that crypto native space even further. So I think a lot of times they have the freedom and flexibility to do things that we just can't do at this point. And there's things that we can learn from them, and also those that are crypto native. There's also things, I think on the last panel, they were talking about sometimes crypto native doesn't always know how to talk to regulators. I do think there's a partnership to also have people from the traditional finance space, Ben, even like your background, to help create that hybrid experience to then help piece things together going forward.
When we discuss the convergence of digital assets and traditional finance, there may be players who are aiming to adopt digital assets. There may be other rather looking for adopting and development traditional finance. What is your view on the market adoption? Oh, yeah.
So I think, adding to Amy's point, I think if the end goal is to have an open, efficient financial system, then we need the best of DeFi participants and the best of TradFi participants. The crypto native participants, or the DeFi guys, they built the technology, they understand the technology, and they're essential in driving the change. but the traditional financial people understand efficient markets, they understand risk management, and they've seen what works and what doesn't work in traditional finance. So I think those two need to work together, and now we're starting to see that change where they're actually speaking to each other and building products together.
I think an interesting one also from your observation before is you have now bankers going to crypto, and you suddenly go to a crypto conference and the discussion is, let's do crypto clearing. Right? It's a very odd one, because when you first got into crypto and digital assets, the discussion, instant settlement is the discussion, right? But suddenly it's crypto clearing for the same reason, settlement efficiencies, right? Risk efficiency through these mechanisms. And I think from if you look at that convergence adoption perspective, right? I think in the end, it's enabling investors to invest in assets, right? And how does it work? You have clients who you enable to invest in a universe of investments you offer. So the crypto native players do mostly, or digital native do mostly crypto, and the traditional do mostly traditional. One has more an older audience, potentially on average age, and the other one a younger one, right? So there's like a market pressure set. Now the question is, when likely assets become digital, who will get the largest wallet share of those future clients? Will the digital natives be able to offer basically the same service, but maybe digitized a traditional player can do, and keep his client and thus the wallet share? Or will they, after a certain age, say, hey, I'm now 35, I want to go to a more traditional player to invest the majority of my assets through them, but potentially does that still into the same ecosystem, right? And there's, I think, a very interesting adoption question is a incumbent versus challenger, but suddenly the challenger in this context might have an advantage on the technology that is used in the future, right? And I think that's something not to be underestimated.
Stephan?
Yeah, indeed. So building on what Ben said, so what we see from a regulatory perspective, also in terms of frameworks. So we have the DLT pilot regime, which really allows the tokenization of financial instruments. So meaning that there is a possibility to have trading and settlement on DLT-based financial market infrastructures. And on the other hand, with the regulation on market instruments on crypto assets, the MiCAR. So there's also for financial institutions an equivalent to provide also crypto asset services. So that is really where all these assets come together. And from a technological perspective, so it doesn't matter what is tokenized or what the digital asset is. So at the point of issuance and transfer, and also on the side of the clients, as Ben said, so it is irrespective what type of digital asset we are talking about. But where it matters is in the middle, where we as a supervisor and also the financial institutions or crypto asset service provider still have to look really for which instruments they are providing services and what provisions have to be applied. So, but from a client perspective, so looking in their wallet, it really depends on what scope of instrument would be available, and that is really an opportunity for all types of market actors here.
Let's talk further about technological enablement through crypto. What changes do you see for the traditional finance? Amy?
I can start with that. I think the one thing we really need to do in the traditional finance space is start having more respect for infrastructure, operations, and technology. I think historically there's been this hierarchy of front office, back office, and it doesn't matter if you're on the sell side or the buy side of the business. I think what that created just over time and different cycles, especially thinking from global financial crisis onwards, was a lot of tech debt that's built up over time. You've also seen consolidation in the U.S., in Europe, across Asia, which has put a lot of these traditional finance firms in operational just mush in the back side of the business. So I think they're really on the back foot here as this, the traditional space, the crypto native and the innovation space continue to move forward. And I do think, this really, is the point that you were making too about sometimes the new player can really step ahead. If you're building from digital up in this environment, you really have a step forward on some of the traditional finance folks.
And as a custody solution, that's what we see a lot, right? So the way it works is you look at, do I partner buy build, right? Do I just externally use an external custodian? And there are different questions around it, but the enablement question is very important. If you don't custody the assets yourself, you're always dependent on others who choose for you on which ecosystem or platform you can play, right? Because only when you custody yourself, you have that control. And secondly, the custody is the building block to first enable your whole organization for digital assets, so for other assets, and crypto has a good assets under custody pricing compared to traditional assets. So there's some money you can reinvest in that technological enablement. But then the next step is, if you don't custody yourself, to then go into tokenization, right? And all those topics, tricky, because the moment tokenization is in a DeFi environment, the key to secure your smart contract needs to be as secure, if not securer, than your private key of your wallet, right? So I think that technological enablement and organizational capability is very important. And I mean, obviously, it's a re-platform opportunity, right? So you start somewhere, and then you might be able, in the long run, to re-platform. The question there is, how long does it take to get rid of all the traditional, right? I think as long as you have that, you will continue to have that mushy bit in the background.
So what are the biggest hurdle for adoption on either side from your perspective? Regulation or the technological infrastructure risk perception? What's your view on this?
Yeah, I can take this one and kicking it off. So I would say, so hopefully from a regulatory perspective, there are no too much challenges, but we see, at least for traditional financial
We
market.
complain later.
Okay, you know my inbox. So yeah, for traditional financial market infrastructures, at least for the DLT pilot regime, so for DLT financial instruments, we see that there is at least no so many solutions provided for the cash leg for in settling transactions. So the European legislator allowed for using e-money tokens under MiCA in addition to commercial bank solutions and central bank solutions. On the other side, what we see really, and also from a technological perspective, is interoperability. So coming back to what is maybe enabler from the crypto space. So there might be new actors or services provided like oracles or bridge provider, really to coming over this technological fragmentation to provide for at least standardization or for agreed solutions to make these different solutions available. And then it does not really depend on what the digital asset is, so being it a crypto asset or a tokenized financial instrument, because finally it is all a digital object which might have some data inputs and can be used on this blockchain. And therefore it is really of importance for market adoption that there are solutions to provide interoperability.
Oh yeah.
Yeah, I would definitely agree on interoperability and fragmentation. I think interoperability in two senses. One, traditional financial systems don't talk to crypto systems yet. Anyone who wants to get into digital assets needs a whole new trading system, risk infrastructure, custodian, exchanges. It's a whole other undertaking. But even within crypto itself, there's lack of interoperability. There's too many chains, too many trading platforms, too many, I don't know if there's such a thing as too many liquidity providers, but just too many players.
Liquidity pools, maybe, is what you're looking for, right?
But yeah, that's right. Thank you. And then I think fragmentation, maybe this doesn't apply to traditional cryptocurrencies, but when we're talking about tokenized assets, or when we're talking about stable coins, you see a new one popping up every day on all different chains, and there isn't a consolidated liquidity around these instruments. They're all kind of trying to rebuild liquidity on their own. But I think that's going to be a secondary thing. First is interoperability. Second is consolidation and building of a secondary market and bringing liquidity.
I would just add, I think that initially it was regulation, but regulation, we're continuing to get more and more clarity on that. I think the hard part is it's still piecemeal. I mean, the new administration, specifically in the US, I think a lot of people waiting for the US to see what they're doing. Moving forward, stable coin bill definitely seems to be at the forefront here. But even with all the changes that we've seen there, SEC changes, SAB 121 repealed, we're still governed by the Fed, and there's still some things on the Fed that need to be settled. Same thing with some of the clarity across the board. I think even if that's clear, though, as we've continued to do more work on vendors and infrastructure, it's feeling very sparse. You know, it's hard to find when you start saying, okay, here's our throughput rate that we need of your technology. Here's the security architecture we need. You quickly start, your lists get smaller and smaller and smaller very quickly because there just wasn't the investment made over the last 5 to 7 years for this institutional level infrastructure. So we're going to be playing catch up here for a little bit before we go forward.
You think there's enough clarity before the next funding cycle end of the year ends? Because that's a little bit my feeling, that the election was at least somehow expected, but nobody really wanted to bank on it. And then the administration came in faster, but nobody had the money to build.
I think so I was just out in San Francisco a couple of weeks ago, and I think one of the issues that we are having, that's like a really good point. The VCs from last cycle aren't getting any exits. And if you go even into traditional private equity, they're having a hard time getting out of their positions. The IPO market hasn't opened back up. The growth private equity guys aren't coming to pick up the VC pieces. So that whole private side is a bit stuck, especially as it relates to this space. I talked to founders and CEOs that I know in this space, and they're all a little bit desperate for some movement here or some new funding.
I think, if I may add the last thing, because you mentioned risk perception, I think finally that's not the hurdle. Like it's not, there are risks in terms of technological risks, but asset classes being risky and dangerous and used for scam, I think finally we don't hear about that as much.
Thank you. Now I would like to ask for some insights on regulatory dynamics in the European Union versus US, in particular in respect of stablecoins, CBDCs, and so on, you name it. Stephan, perhaps we can continue with you.
Yeah, I can start. So at least for what I have seen, so I'm not in the details what is actually happening in the US, but I see that there is a favor for using stablecoins instead of wholesale CBDC. So and that is what we actually see here, and what, at least from a regulatory perspective, for really covering capital markets and financial market infrastructures. There's also agreed on international level to use central bank money wherever practical available, so really to ensure settlement. And now we see here changes in the US, so to provide from DLT-based solutions, really bring it to the market to provide business there in stablecoins, and that is different to what we have here. So we have seen that the ECB will, base on their exploratory work, and I guess Ben could also provide some insights here, a solution really also on a short term to allow DLT-based settlement also in central bank money. And that is one of the main difference I have identified so far, and how that will be built up and how stablecoins will be used and issued in the US. So that is something we will see in the near future.
So looking at, it's different layers, right? If you look at there's a problem in the discussion of commingling digital euros, so retail CBDC and wholesale CBDC. And I can speak for the wholesale CBDC thing. My perspective is that's something the industry wants, right? And if you look at how it was announced in the US, it was truly around retail CBDC. But it's very difficult if you don't make that decision to walk back from it, because central bank money is already digital, right? And so I think that there's nothing new there. So let's see how that plays out. Then if you then go ahead and assume there's no central bank money available for settlement, and you bank on stable coins to work, then suddenly it's, at least from a crypto perspective, also the following. You have, what, 99% in crypto is settled in US dollars, and some percentage maybe in euro. And now in Europe, we enforce a European-based stablecoin, but that stablecoin is financially just not as attractive. it's not yield bearing. The underlying doesn't give you enough yield compared to US stablecoins. So a US stablecoin company who wants global adoption, that's very important, not within Europe, but global adoption, suddenly has a lot more money to spend to increase adoption. Let's assume the one dominant player will not stay there forever, but others will come, right? They have a lot of more money to spend to increase adoption, to foster and create an ecosystem versus European ones. So I think if we see the current setup and the certain current competition of systems, the dollar dominance aspect of stablecoins, if the US legislation comes out the way it's expected, should be more or less enshrined. And then it's a question what we do within Europe, right? And then I think that's also an interesting one, right? Whether you use wholesale central bank money versus stablecoin, I think that's a very interesting one. But the moment wholesale central bank money is available, and you can, for example, settle crypto in it, just imagine as a Morgan Stanley comes online and can then settle wholesale crypto transaction in the same liquidity pool that used for all the other capital markets transactions, would be a great setup. So maybe there's an opportunity there we don't have in the US yet.
Amy, you are based with Morgan Stanley in New York. What is your view out of US?
I think stablecoins is the new house on fire right now. It seems, I don't feel honestly like we did that much work on it over the last few years. And now it seems to be everything anyone can talk about. And it's also like, wait, where does it plug in? Does every financial service need to issue their own stable coin? Do corporates need their own stable coin? Where's the interoperability here? Is it for payment rails? There's like a whole further discussion that I think has really confused a lot of the people in the traditional finance industry, because hey, we were just talking about like Bitcoin and getting our 100% return every year, and we got our ETFs approved and like this, that I thought that's what we were working on. And here all of a sudden you're just talking about tokenizing US dollars. And then what the use cases are, obviously Argentina and other countries around the world love to have some sort of more stable place to hold value. Maybe it's not Bitcoin, maybe that stablecoin solution works there. But I think the thing that then we start getting into when you actually start having real deep conversations about this is on and off ramps. The back end of those stable coins, are those money markets, are those treasuries tokenized? Because if you need to keep on and off ramping to manage that stable coin backing, we're not there efficiency wise. So somehow we need to figure out what the right scaffolding is and then build the right layers. Because soon as we get and I think the other thing too is if stable coins really take hold here and grow pretty rapidly, we could have this tokenization that we've been talking about for years in the digital asset space really start to play out, because then you have more use cases that start to really resonate. If it's the tokenized money markets, if it's using stable coins within an organization like Morgan Stanley, rather than sending wires for like capital calls for private equity funds, maybe you just transfer stables into those capital calls. So you can really come up with some really interesting use cases to talk about then.
Let's spend some time on the future trends and outlook. Oh yeah, Amy, you are, so to say, representing traditional institutions. What are some of the latest developments you see in terms of private change, public change, tokenization trends? What is your experience?
I'll start with tokenization, because I think this has changed dramatically in the last 4 or 5 years. I think initially people looked at tokenization as a way to make illiquid asset classes more liquid. So people were tokenizing art, real estate, like luxury cars and whiskey collections, things that no one really wanted or needed to be tokenized. And I think it was very clear that there wasn't demand for this. In the last couple of years, this has shifted completely, where we're now taking very liquid instruments like US treasuries, like money market funds, and hopefully soon listed equities, and tokenizing that And that way you're able to benefit from the liquidity of that underlying instrument. And there's an existing use case for that on chain. So you're not creating something that no one really asked for, because stablecoins itself was the first really tokenized instrument. It's tokenized dollars, and it was extremely quickly adopted and became hugely successful. So I think that shift in our understanding of tokenizing assets and where the demand is, and following that demand and product market fit, has proven to be more successful. And I think we'll see more of that.
Would you like to continue, Amy?
I think for a long time it was private chain only, at least in the traditional finance space. I think there's no way we're going to public chain discussion for many years, and that seems to definitely shift in the last 12 to 18 months or so. I think now it's pretty clearly, at least in my mind, that will be in some sort of public chain format going forward. Maybe some private layer on that, or some sort of controlled layer on top of it. But I do think public chain is basically now the theme of the discussions.
What will financial markets look like in the next year or in 3 years? More integrated, still fragmented? Will there be convergence in the upcoming years? Let's take a look from each of you on this.
Yeah, so I would assume that there is still some time to go in adopting DLT. So what we see actually is that there is a fragmentation based on different technical solutions. So as we heard, so there are different protocols available, and if the market would potentially move to apply for public permissionless blockchains to provide services or tokenized instruments, so it will start with increased fragmentation, but and hopefully at the same time, so that is what I'm really looking in, is how this can, how interoperability can be ensured. So really looking if there is standardization, or on the other hand, if there is additional opportunities or solution provided by tech companies like Oracle or Bridge Solutions, and then we will see if the market can agree on specific protocols. And on the other side, we see also initiatives like unified ledgers. So that would really depend, and looking at financial institution and capital markets. So then, yeah, it would depend on the infrastructure which is used and really can attract most of the institutions or large players to be used. And therefore, I would assume that for the coming years, there is some kind of hybrid solution referring to traditional capital financial market infrastructures, but at the same time developing further DLT-based solutions, and also then take the potential benefits which these solutions might use, like having digital objects bearing specific information in the objects themselves, which can be used for further services or for increased automatization of settlement activities.
What do you expect, Uya?
I agree. I think there'll be more fragmentation before there's consolidation. I think ultimately, and this is not this year, probably not next year, but ultimately there will be hybrid platforms where it's seamless. So you could be trading stocks, but you don't know if it's tokenized stocks in the back of it, along with cryptocurrencies, along with other digital assets. And I think that will be one hybrid cohesive platform. This is maybe a bit too optimistic, but I think ultimately that's where we're finally going.
Amy?
I think we need a crisis. We need to feel the hurt in some way to push us further. I truly believe that a lot of the biggest movements in the market happen after there's some sort of totally chaotic moment. And I don't know how that's going to come. I brainstorm with lots of friends in the industry, like, is it stable coins get set up? And, you know, then we really have some sort of situation where stablecoin has immediate settlement and the traditional finance gets locked up, not being able to deliver liquidity, or, you know, something like that can really push it over. I think similar, like, even if you just think of the DeepSeek moment that happened to all the AI companies, that was like where did this come from? Oh, like, they were doing it cheaper, faster, and all of a sudden now everyone's, stressed out in terms of what the model looks like. So I do think we need one of those moments. I can't say exactly where it's going to come from, but I'm waiting to see where that emerges.
So I think there are different steps, right? One is, I think crypto could be the use case that pays everyone to build the necessary infrastructure to partake in that future, right? On the one side, it's the digital native firms who already make huge amounts of money many times on it, who now can use it to go somewhere else. And for traditional players, enabling crypto, keeping clients, charging, and you build your own infrastructure, I think that should not be underestimated. That gives you the capability to then play in that DeFi environment, but that DeFi environment has, until now, not managed to create large enough liquidity pools that are relevant for capital markets. And then there's the competition will that DeFi environment evolve versus something like unified ledger, something bigger, where then based on the technology DLT and blockchain, large but very efficient and automated ecosystem could evolve, which are at the same time very large liquidity pools, right? And I think, not sure how that plays out. Now being more in crypto, I'm a little bit more torn. Last year I would have said it's a very clearly unified ledger. So it depends on the vantage point, but at least I think that competition will be there. What I think will push it over the edge is you're 18, 16, 17, 18 now. You go into crypto, you take daily investment decisions, you're very comfortable with that, right? But you don't really have any money. So it's not relevant for capital markets. In 10, 15 years, you do have money. The question then is, will you continue in your crypto DeFi environment? You're very comfortable with taking decisions or not. You're comfortable with leverage. You can do a lot of these. You can do a long-short strategy, all of that, like an investment banker, but in your phone. Will you continue to do so, or will the traditional infrastructure provide you the technological means to do the same? Maybe, and then I understand Stephan would say in a more regulated way, right, and more secure, but I mean, also regulator wants more capital to go into more regulated space than staying completely out of it. So I think that competition is on. Will the 35-year-old then attribute his wallet share in the traditional way or not? And if they start not to do it, I think that's then the moment you alluded to, right? Where then suddenly everybody gets a little hectic and might move faster because they lose the future client base.
Just one more point on that. So Robinhood earnings came out fourth quarter. I don't know if any of you saw those. 50% of their revenue driven by crypto trading. That was definitely a bit of that deep seat moment. Like, where did all this come from and why aren't we capturing this? So I think if we have more of those, it's definitely going to help accelerate it.
Then let us continue with the closing round. Please give your takeaways from this panel. Convergence of native digital assets and traditional finance in 2025 and in the next years, starting with you, Stephan.
Yeah, thank you. So what I take away is that the convergence already started, and it really depends on the use cases and the different perspectives, like financial institutions or like crypto service providers or tech providers. And then it really depends on how market will evolve and from taking the client perspective. So I would assume that really here's a technology provides for new opportunities because on the client side, so it really doesn't matter what type of instrument I'm invested in. So not speaking from a risk perspective or regulatory, but really how my app would look like and what I can do within that app. And then I would assume that really allows for convergence, and anything what is related to regulatory provisions or frameworks would then be addressed by the competent authorities, but also by the financial institutions.
Thank you, Stephan. Uya.
Yeah, I think one of the catalyst moments was the creation of ETFs and the massive success of ETFs. That was allowing traditional financial people or people outside of crypto to invest in this asset class in a familiar wrapper. Now I think we're going beyond the investment stage into building actual technology and infrastructure to remove that additional layer so you can have direct access.
I think at the traditional firms, a lot of this has been happening in very small size in the shadows. And, you know, even you talked about, oh, we're not really involved. Well, that might not totally be the case if you really dig around. So I think it's one of those slowly and then all at once sort of scenarios where once it just starts gaining enough scale, they may actually have to start building some of their own tools, and then that'll really start to catalyze things.
I think it's very straightforward. I think difficult to see how the future plays out, but it seems to be digital. And the one rule always has been always the same, right? If you want to play, you have to be able to, right? So they have the technology and the foundational layers ready, and I think back office and technology and operations is a great example. If you have those available, you're able to play, you can. People did push it off for many years, but I think now is the moment you have to start, because otherwise you miss the point where you're able to play and shape that environment to your advantage as an organization.
Thank you very much.